I would like to teach you something. And if you indulge me these few minutes, you may very well change your trading life, your investment life, maybe your financial destiny. I am Bagadon at StockMarketCaddy.com. Today is Monday, April 7th at about 6:30, and the markets have been getting hammered. And there was really no reason for anyone to suffer the losses that they have suffered. If you are tired of listening to CNBC, the Contrarian News Business Channel, Joe Bagadonuts, Becky Not Too Quick, Steve Leisman, the Rodeo Clown, Jim Cramer, or God knows Aaron Burnett over at CNN for your financial review, I hope you will stay with me. Let me share with you what my wife and I have built decades ago. It is a decision-making trading tool called SMC for Stock Market Caddy, excuse me, the Swing Machine Plus. It operates on the TradeStation platform. In particular, their proprietary tool, they're the only company to have it, called Radar Screen. By the way, we build dozens of other such tools. And these tools could very well be on your desktop for the next big rally or the next big crash. Let me share with you what you can do here. Skew. Now, you may not know what skew is, but skew is important. $SKEW.X. Skew tells us how the big money, the billionaires, are positioned on their holdings. 30 plus days ago, the skew was solidly green. It was in euphoria. It was giving us a reading of 182, the highest skew reading that I can remember in years. In order for the skew to get that high, the smart money, the billionaires, have to be doing something very specific. And they were, we now know. What was it they were doing? They were selling calls to the speculators, and they were buying puts as the market went up and up. They were getting defensive. When you combine a very high skew with a fear gauge, and let me show you, we'll call this the VIX fear gauge. And we'll use the continuous contract, futures contract, VX, excuse me. The VIX fear gauge 30 plus days ago was not green. It was red, and it was in panic. So we had the skew in euphoria here. We had the VIX in panic, a very explosive combination. Explosive to what, Bagadon? Well, let me show you. Now we're going to add label row, and we're going to put in the S. Oops, sorry. S&P 500 index, cash index. And we like to track it because as it goes, so goes everything else. And we will put in the S&P cash, SPX.X. Now, 30 plus days ago, the S&P was solidly also long. Where was it? It was up in euphoria. What was the price of the S&P? It was at 6,100, 6,200, very, very high. And we said to our members, and we said on YouTube many times over the last 30 plus days ago, back in January, you can look at our videos. We said we have a very high skew. We have a very low VIX. And we have a very high market. It is time to brace for impact. That was the title of our video. You can go back and see it. Now, you may be looking, $893, that isn't much. That's 893 points. If you had bought a put 35, 40 days ago on the S&P, you would have realized 893 points. That put 40 days ago would have cost you $10,000. $10,000. That would have been your maximum risk to ensure a $500,000 portfolio. Today, that put, if you still held it, would be worth at least 90, more likely 120,000 because of the increased volatility. If you were comfortable with futures, I will put the continuous contract in here on futures to show you, because you see, we want to be diversified not in what we hold, but in what we can do. If you had gone short a futures contract, one mini contract, 31 days ago, 30 to 31 days ago, when this was flashing, sell, 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 one contract would be worth $44,000, $500,000. Now, what about now? Everybody is panicking. Everyone is expecting the market to go lower. Well, the daily trend is certainly down. But in a bearish phase, we can get vicious rallies. And last night, we were telling our members that we now have the VIX in euphoria. Let's move back a little bit today, but last night, it was in euphoria. And we have the S&P in panic sell. And that now would be the time to close the bulk, if you hadn't already rung the cash register, to close the bulk of your shorts. And to do what? To get on the long side as a trade. How might you do that? I'm going to show you what we did today. This is a view of the TradeStation product called OptionStation Pro. Here is the SPX. We came into the market today and we bought 2 call contracts when the market was trading at 49.70. We bought them for a duration of 45 days. Each contract, fairly expensive, cost us about $27,000 some odd $1,000. So the total trade cost was $55,580. A fairly large trade. However, I do want you to know that you could have done exactly the same and done it off of the SPY, the SPY, at 1/10 the size. We placed that trade this morning when everyone else was panicking, when everyone else was waiting for the Jim Cramer crash. We trusted our dashboard that I just showed you, and we placed our trade. If we were to close them now, which we're not going to do, we could realize a profit of 11,610, a 20% return in just one day. But we're not going to do that because we still have quite a bit of time. The most valuable commodity of all, folks, is not a call contract or a put contract. It is not gold. It is not Bitcoin. It is not silver. It is time. You can't make it. You can't buy it. You can't sell it. But you can waste it. If you want to learn how we go about trading the markets and getting an education to couple your use of these tools on your desktop, you want to be sure to visit our website, stockmarketcaddy.com. It's a small miracle you found us because we don't advertise. But if you want to listen to the CNBCs of the world or the Davy Day Traders, we're going to wish you the best. But if you want to take control over this part of your life, we're ready when you are. Feel free to give us a shout. I'm Baggett at stockmarketcaddy.com.